When an entrepreneur goes to seek external equity financing, there are several sources that are typically available. And in this document, what it asks us to do is describe each source of capital and explain if and how each source of funding impacts company control. So the big idea here is that each source of capital is going to influence each source of capital is going to influence company control in some way. By nature of the term equity financing means you're giving up some ownership in exchange for some money that can be pumped into the firm and help the firm grow. So the first source on this list is angel investors. And by definition, an angel investor is an individual who buys equity in small private firms. So typically, this is going to be some sort of wealthy individual who is looking to make some sort of investment, maybe get some better bang for their buck than they would get elsewhere, like in the stock market. A lot of times, this may still be a friend or of the entrepreneur. It may be it may be someone that they meet along the way through running their business, and so it could just be some sort of acquaintance that they know that is willing to invest in the business because they think it'll be a success. So typically, for most firms, when they're small, this is going to be the first source of external equity financing that they get. And these will end up being relatively small investments compared to some of the other sources of funding. But this is a way to really get the company moving more in the direction of growth. And so so this is if you're thinking of what a most likely scenario is for a small firm that's looking to continue growing via equity financing, it's going to be coming from angel investors. So angel investors, often the first source of outside private equity. And this first round of financing, the first round often comes from one or two angels. And these angels receive private equity, meaning that they're getting some shares of ownership in the company that are not traded in public equity markets, and it's going to be in return for a monetary investment that's often between $50,000 and $400,000 total. So in some cases, if you read, there's a section of the text that there's an interview with a particular angel investor, and that angel investor states that they consider a typical check that they issue to a business in exchange for equity ownership to be around $25,000. So some angels consider the typical investment to be $25,000. So what happens in exchange for that money, like we said, it's going to be an equity stake. So in addition to receiving some stock, the angels will oftentimes get a seat on the board of directors. And throughout this chapter, if we're referencing the board of directors, we're just going to use shorthand and say BOD, short for board of directors. What that means is if they're having a seat on the board of directors, in terms of organizational structure, the board of directors is the top governing body of the organization. It's the board of directors that basically sets marching orders for a company's managers and says how the company's managers are supposed to act, the types of things that they should be doing, and it's up to the managers to enact those strategies on a day-to-day basis. But bottom line, what this means is the angel investors are getting a seat on the board of directors, and that helps really set out the vision for what the company is going to be doing going forward and what its strategic objectives are. So because the angel often gets a seat on the board of directors, they have this ownership stake. Typically, the best kind of angel investor that you can get is the angel investor that has some sort of industry expertise, someone that knows what's going on within the industry. So they bring industry experience, expertise, and contacts for the entrepreneur. And the reason that they would be willing to sort of share their expertise, use the expertise to guide the company down the right path, and make use of their contacts for the company is because they have this equity stake. It's an investment. They're looking for a rate of return. And from their perspective, if they can take the company down the right path, they'll earn a positive return on their investment. And that's exactly what they're looking for.